Welcome! In this video, we will analyze whether XCN or XLM does 100x first. We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
But first, let's analyze the XCN.
First of all, when we talk about the existence of such a downtrend, from a technical analysis perspective, we're acknowledging that the price has been under downward pressure for a certain period of time, meaning that sellers have been acting stronger than buyers. A downtrend is typically defined by the price making lower highs and lower lows each time, and during this process, investor psychology plays a major role, because the continuous downward movement of the trend creates a sense of hopelessness and distrust among market participants. This often increases selling pressure. At this point, saying, first, this downtrend needs to be broken expresses the most basic condition for the price to start a new upward move. In other words, the market must shift from a phase dominated by sellers to a phase dominated by buyers. As long as this breakout does not occur, upward expectations remain cautious because the price is still considered to be under the control of the downtrend. Breaking a downtrend is not just about the price closing above a technical line. Looking deeper, this breakout represents a psychological threshold being crossed. Since investors are used to the price constantly falling, the trendline acts almost like an invisible wall. Overcoming this wall, that is, the price moving above the trend, shows that buyers are finally starting to enter the market more strongly. For this reason, when a breakout happens, there's usually a wave of confidence in the market. Buyers regain courage, while sellers realize they are no longer as dominant and begin to retreat. This in turn paves the way for upward moves with stronger volume. The most important point to watch here is whether the breakout is false or not, because not every downtrend breakout signals the start of a real rally. In some cases, the price may move slightly above the trend line, but then fail to hold and fall back down again. Such cases are called a false breakout. To avoid being misled, the price should remain above the breakout level, preferably make several closes there, and show additional indicators to support the move. Volume plays a particularly critical role here. If trading volume increases significantly compared to previous periods during the breakout, this indicates a strong breakout because it shows that buyers are entering the market collectively. Breakouts with low volume, on the other hand, are more likely to be misleading. Emphasizing that a downtrend must be broken actually means pointing out the basic condition for a directional shift, because a downtrend is like a river pulling the price downward. To reverse this flow, the price must cross the riverbed. Moving above the trend line represents breaking free from this channel. From there, the price can create a new channel aiming for resistance levels it could not break before. That's why investors closely follow downtrend breakouts and often adjust their positions accordingly. Especially the breakout of a long-lasting downtrend can often lead to a strong and rapid rally. This is because there is pent-up buying interest in the market, and once the breakout occurs, this desire creates a chain reaction that pushes the price upward. This breakout can also be supported by various patterns in technical analysis. For example, if the price breaks the downtrend while also forming an inverse head and shoulders pattern or a double bottom pattern, the probability of an upward move increases even more. So while breaking the downtrend is an important signal on its own, combining it with other structures gives investors much greater confidence. The increase in confidence attracts even more buyers, accelerating the momentum of the rally. When explaining the necessity of breaking a downtrend in detail, it's also important to consider how this process affects an investor's psychology. Constant downward price action creates impatience, fear, and even hopelessness among investors. But when the trend is broken, these feelings suddenly shift to excitement and hope. Investors start to believe the bottom is behind us, a new bullish period is beginning. This belief influences market behavior. Whereas the market was previously driven by selling pressure, it now faces buying pressure. As selling decreases, the strength of buying becomes more evident. This lays the foundation for the price to rise step by step. From a technical perspective, when a downtrend is broken, investors usually first set their targets at the previous high points, because once the trend is broken, the natural places the price wants to test are the resistance levels it couldn't break before. As these levels are surpassed, the upward momentum grows stronger and the foundation for a new uptrend is built. Therefore, until the downtrend is broken, all of these expectations remain speculative. But after the breakout, a real change begins in the market and the path for a rally becomes much clearer. but we can't make decisions based on trends only. So let's take a look at other metrics as well. Stay tuned.
In Elliott wave theory, one of the most critical rules concerning the second wave is that the price must never break below the starting point of the first wave. If the price breaks this starting level, then the second wave count becomes invalid, and the structure in question cannot be considered a classic Elliott formation. The rule is simple. The second wave cannot exceed or violate the start of the first wave. This principle is regarded as one of the most fundamental and indispensable aspects of Elliott wave theory, because the entire mathematics and hierarchy of the waves are built on this logic. Let's now break this down in detail. First of all, the first wave is often seen as the move that signals the beginning of a new trend in the market. This movement is typically recognized only by a minority of investors. It is a pioneering step. In other words, the market is preparing for a larger rally or decline, but most investors do not yet realize the scale or potential of this move. When the first wave starts, the majority of market participants still believe the previous trend is continuing, and they are slow to understand that a new trend has begun. That's why the first wave represents the early entry of a strong minority. Following this, the second wave comes in as a corrective move. It retraces the initial rally of the first wave. During this retracement, market participants face serious hesitation. Some believe the rally was a trap and that the price will return to its old direction, while others recognize it as merely a correction. However, the second wave can never retrace beyond the start of the first wave. If it did, this would show that the trend had not truly changed and that the first wave was not the beginning of a new trend, but only a temporary move. That's why while the second wave may approach the starting point of the first wave, breaking that level completely invalidates the theory. Elliott's framework is extremely clear and strict at this point. The logic is simple. If a new trend has begun, no matter how sharp the correction may be, it cannot break the root point of the trend. Once that root is broken, the new trend cannot be validated. This means the supposed new trend has been canceled. Now, let's look at this from the psychological perspective. When the first wave begins, some investors open positions. During the second wave, many of these investors begin to take profits, closing part of their positions. This naturally pushes the price downward. But here's the crucial detail. If the second wave were to drag the price all the way down to the start of the first wave and even break it, most of the investors from the first wave would be in loss. That would completely shatter the psychology of the trend. Elliott wave theory is fundamentally rooted in market psychology. The cyclical movements of human emotions such as hope, fear, patience, panic, and euphoria form the basis of the wave structures. Thus, the second wave can retrace the move, but can never wipe out the starting point of the trend. This works almost like a law of nature. On the other hand, although the second wave is a corrective move, it is followed by the third wave. The third wave is considered the strongest and longest wave in Elliott wave theory. This means that when the price retraces to the edge of the second wave, it is actually building up massive energy for the third wave. That's why the start and end of the second wave are extremely critical. The potential of the third wave is determined by the depth and limits of the second wave. If the price turns without breaking the first wave's starting point, this gives a highly positive signal that the third wave will be powerful. For example, let's say the price rises from 100 to 150, forming the first wave. Then the price retraces from 150 down to 120. This forms the second wave. If the price were to fall below 100, the starting point of the first wave, the second wave would no longer be valid and the Elliott count would be invalidated. This is because falling below 100 would show that the move was nothing more than a temporary bounce. But if the price holds above 100, say at 120, and then reverses upward, this confirms that the second wave has ended and the third wave is about to begin. This creates a major opportunity in the market because the third wave is the strongest and fastest rally. Therefore, the fact that the second wave cannot break the starting point of the first wave provides significant confidence to investors. They know that as long as this critical level holds, the trend is intact and ready to continue. In a sense, this acts as a proof of the trend's strength. This is the most fascinating aspect of Elliott waves. It is not only a mathematical theory, but also a system that reflects the depths of human psychology and market dynamics.
Additionally, the second wave's inability to break the start of the first wave is directly tied to Fibonacci levels. Most of the time, the second wave retraces to the 61.8 or 78.6 Fibonacci levels of the first wave. In other words, the price falls to these levels and then reverses upward. This reflects the natural mathematical boundaries of the second wave, since Fibonacci ratios align with the psychological thresholds that guide investors' trading decisions. Therefore, when the second wave reverses at 0.618 or 0.786 retracements, it aligns perfectly with both Elliott's rules and Fibonacci logic. However, the price can never make a 100% retracement, because in that case, the trend would be invalidated. One of the most frequently asked questions in the crypto market is which coin can achieve a massive surge like 100x faster or sooner. Investors, in their pursuit of growing their capital, often look for high potential projects, and market cap has become one of the most critical criteria in this search. Let's take two examples here: XLM, Stellar, and XCN, Chain. When comparing these two crypto assets, one of the most significant differences is their current market capitalization. XLM, with a market cap of $12.31 billion, makes a 100x move almost impossible. If it were to achieve this, XLM's market cap would exceed $1.2 trillion, a size that would rival the market capitalization of the largest companies today and even challenge traditional investment assets like gold. In other words, a 100x increase from XLM's current position is practically unthinkable. On the other hand, XCN Chain has a market cap of around $419 million. Since this figure is much smaller, for XCN to achieve a 100x increase, its total market cap would need to reach approximately $41.9 billion. Looking at historical examples in the crypto market, we've seen many projects hit $40–50 billion market caps. This makes such a target much more achievable for XCN, especially during a bull run. That's why XCN has a significantly higher probability of achieving 100x compared to XLM. Mathematically, lower market cap assets have far greater upside potential. Of course, a purely mathematical comparison isn't enough. One must also consider the project itself, community strength, use cases, technology, and investor interest. XLM has been around for years and is used for cross-border transfers and payment solutions. Because it aims to integrate with the financial system, it is more tied to regulations and large-scale partnerships. This factor limits its growth speed. In short, XLM has already grown to a certain point, gained trust, but its massive market cap reduces its flexibility. For it to achieve 100x, we would need a revolutionary global adaptation of the financial system, something highly unlikely in the short term. In contrast, XCN is a smaller and more flexible project. It's still in a relatively early stage, and due to its low market cap, achieving massive gains is mathematically much easier. Therefore, a 100x surge for XCN is far more realistic both technically and in terms of market potential. Of course, this also comes with higher risks. Lower market cap projects are more volatile and experience sharper pullbacks during downturns. For investors, this represents both a major opportunity and a major risk. To illustrate, let's say an investor puts $1,000 into XLM. If XLM doubles, that investment becomes $2,000. If it goes 5x, it becomes $5,000. But for a 100x return, XLM's market cap would need to reach $1.2 trillion. That would make it one of the most valuable assets in the world, which, given how markets work, is nearly impossible. Meanwhile, the same $1,000 invested in XCN could potentially grow to $100,000 if it achieves 100x. For XCN, reaching that level would only require a market cap of around $41.9 billion, something we've seen in crypto history. The math is simple: smaller numbers can grow faster. Looking at this from another angle, the crypto market has what's known as the network effect. Projects like XLM, which have been around for years, benefit from a strong network effect. They have large user bases and credibility, but their size prevents massive surges. Each price rally comes with increased selling pressure as people cash out their XLM holdings, making upward moves harder. This is why coins with massive market caps cannot realistically go up hundreds of times. But smaller projects like XCN face less selling pressure, making price movements easier and quicker, especially when investor interest grows. Still, it's important to note, even though XCN has a much higher mathematical chance of achieving 100x, this doesn't mean it's guaranteed.
A coin needs more than just a low market cap to grow 100x. It also needs strong use cases, an active community, developer support, and a narrative that can trend in the market. Without these elements, even small cap coins can fade away. That's why relying solely on market cap for investment decisions carries great risk. But we can say with confidence that while XLM reaching 100x is almost impossible, XCN achieving it is at least theoretically possible. Historically, many altcoins have delivered 50x, 100x, or even 1000x returns during bull runs. The common factor among them is that they all started with small market caps. Today, XCN falls much closer to that category. All it would need to achieve such growth is a major bull cycle and the right positioning during it. XLM, on the other hand, would still rise in a bull run, maybe 3x, 5x, or even 10x, but a 100x move remains unrealistic because of its already massive market cap. In conclusion, when asking which will reach 100x first, XCN or XLM, the most logical answer is that XCN has far greater potential than XLM. The reason is not just its smaller market cap, but also the natural flexibility and faster growth capacity of smaller projects. From an investor's perspective, XCN's 100x potential is much more realistic, while XLM's is almost a fantasy. Of course, investors must carefully weigh the risk-reward balance, since huge potential also comes with huge risk. But based on crypto market dynamics, it is a proven fact that small-cap projects are always far more likely to achieve 100x moves, and history has shown this time and time again.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.